Hello, Marc from ADM Investor Services International. With some thoughts this week on yields, and this applies across the board, and particularly within the phenomenon of market risk taking. I'm going to start off with a very familiar chart. It's the VIX Volatility Index. And it's one of the reasons why people are chasing returns, chasing yields, wherever they can look, as much as the VIX Volatility Index is establishing itself above the 20 level, well above the sort of levels that we were seeing pre the big shock of February, March of last year. It remains very low and certainly nowhere near the sort of levels that we were seeing last year. However, my next chart also brings us to another point, namely, this is the US 30-year yield, and as one can see, it's been steadily rising. We have been flirting with the 2% yield level. We haven't been close to that level for quite some time, certainly not since post-COVID, and certainly not since the Fed started providing the market with exponential huge amounts of liquidity. But it's important because as we get closer to 2%, so the US long bond yield becomes somewhat more attractive than, say, when it was close to 1.25%. And that sort of gives us a window into something else which we need to keep an eye on, namely that we've had actually quite a lot of speculative money going into commodities. And one of the reasons they're going in is not simply because of the expectations that vaccines and our gradual sort of economic recovery will speed demand for commodities, and particularly for a vaccine-led recovery, but also because of yields. So I'm going to show you three charts and explain why the last one, why it doesn't quite work. So the first one is the Brent 1-year curve, or oil futures curve. Basically, this is just simply the differential in price between the first month futures contract and the 12th month futures contract, and that applies to all the other charts that I'm going to show. And basically, one can see the magic number on all these charts is 0. So when you go above 0, so you've got a positive carry, so you generate yield if you're just rolling down the curve. And as one can see, one's gone into a positive curve here, and the sort of yields that this is implying now are actually a lot more attractive and available in treasuries and indeed in the corporate area. And so it's a little surprise that we're actually seeing people chasing the Brent, both the Brent and WTI futures for yield rather than just based on economic recovery. The same thing applies to my next chart, which is copper future. And as one can see there, this is also in a positive carry on this one. However, my fifth chart is silver, and this is a reminder why when we had that speculative squeeze the week before last, that it couldn't last simply because the carry here is not positive, it's negative. It's getting close to positive, but for the time being, it's negative. And it would, to get further traction from a yield carry perspective, need to go further. My final chart, I think, is the most important one in terms of the rise in the US 30-year yield, and it indeed also applies if we get a further rise in the US 10-year yield. Namely, this is the S&P 500 dividend yield. And as one can say, at the end of January, this got down to 1.57%. So we're now, in terms of the US 30-year yield, well above that. And the US 10-year yield, should it continue to rise, this will become less and less attractive. And so you might see some rotation both into treasuries and into commodities as a result of that. So some things to think about there in terms of yields and investor trends at the moment.